We're here at the 2010 International Conference on Sustainability, Energy, Economy, and Environment, and today we heard from some very interesting speakers about money. With us we have from Australia, Professor Steve Keen, from Ottawa, Canada, Nicole Foss, and from California, USA, Ellen Brown. And my name is Aaron Wissner, and I'm from Michigan. So the first thing I'm wondering is, what is it that people really need to know, and this is for all of you, what is it that people really need to know, normal people, working their jobs, with families, in the world, what do they need to know about money that they don't know? What is the big thing that they just don't understand about it? All of you, okay. Whoever wants to jump in.
Well, I would say that it's more ephemeral than they think. It's more ephemeral than they think. So it's something that's the supply of which is relatively easy to take for granted at the level that one is used to, but that level can disappear. And so people really do need to think about how monetary systems work.
Okay, ephemeral is kind of a big word. What do you mean by that?
It can inconveniently disappear on you.
Are you saying that money is not real?
Well, certainly credit is not. And a lot of what we consider to be money is a loan to us. We have lent the bank money. They had essentially a bank balance as an IOU in our favor.
Let's hold the mics.
I mean, a lot of what we consider to be savings or value really is not something that is inviolate in any way. I mean, you can easily end up losing access to credit and then losing a bank balance in a bank run, and then all of a sudden you simply don't have any access to cash. So people have to be aware that changes in the monetary system can happen quite quickly, and that it can be very much like having the rug pulled out from under your feet.
So money is something we shouldn't trust as much as we do.
We trust in its availability, and especially the availability of credit at this point. A lot of people don't even have savings because they just think, well, I have my credit card balance and I can rely on that, and they may be in for a surprise.
Okay.
Well, I think to me people have to realise a lot of what they've been told about how money functions is a set of myths. And the trouble is they're myths at both extremes of the political spectrum. There's a myth about money creation that says it's under government control in a sense, and therefore any problems are due to the government, which you can take from the Milton Friedman end of the spectrum. And that tends to be how economists think about the functioning of money. And at the other extreme, a lot of people regard money as being something which should be a commodity, should be based on gold and so on. And in the sense that it's ephemeral, as Nicole said, it's fundamentally always been based on trust. And that is not necessarily a bad thing. It's just that as it's being such an ephemeral thing, it can be expanded and finance speculation rather than real investment. And
What do you mean by speculation?
Gambling on asset prices.
Give me an example.
Taking out margin loans to buy shares in the NASDAQ, which is a popular pastime before 2001 struck. Or taking out a mortgage and buying a couple of properties and playing the American game of flip that a house, and believing you're making money out of it and that you're actually an investor.
And what's wrong with that?
It's only the real force that's driving it higher is people taking out more and more levels of debt to buy the house off you at a higher price and you bought it off somebody else with less debt. So the actual mechanism is rising levels of debt. And the trouble is that generates an additional money supply, but it also generates a charge. You've got to actually finance that. And since all you've done is drive up the price of a house without actually adding to the productive capacity of the country or the income being generated by the house itself, you end up adding to debt without adding to income, and finally you get to the stage where you simply can't finance the debt out of your income and you have a financial crash like the one we've been through. So money is a bit like handling and letting people play with money as we've done by making it unregulated and saying, you've got the right to decide what's the best way to use it, is a bit like giving people nitro and glycerin and say, please combine the two to your pleasure. Somebody knows what they do can open up a mine, another person can blow the mine up. And we've actually been in the blowing mines up business in the last 20 or 30 years rather than using money productively.
I would agree with Steve that there are many, many myths about money, and it's important to understand what money is. But to me, right now, the most interesting thing that people don't know and that they should know is that if you have a mortgage, 62 million mortgages right now are held in the name of MERS, the Mortgage Electronic Registration Systems, which is, many lawsuits are now finding that MERS does not have standing to foreclose on your property. In other words, you may own your property free and clear. Most people don't know that, and if enough people knew it, then they could organize. What we need is some clout against the banks. The banks own Congress because they've got all the money. And us individually, any one individual who goes into court and argues might actually win, but they're just one, the bank will settle with them and get rid of them, and it'll all be kept quiet. But if everyone knew that we have this possible leverage here, then we need to have an organized movement of some sort, and we need something to form this movement around. And I think right now that is the most viable issue that we could form around, where we could actually get some real power. And the reason that's a money issue is that the Mortgage Electronic Registration Systems was this electronic system set up to avoid the recording statutes, and it's how all this securitization took place. So behind this curtain of MERS, all these trades were going on where your piece of real estate suddenly became the gold in this fractional reserve system called a shadow banking system. I mean, it was bits of mortgages that were being traded around many people and being bet against and gambled on. And in fact, that's one reason the subprime mortgages were so bad. They were looking for bad mortgages because they wanted something to bet against. It was the big case we heard about was Goldman Sachs and John Paulson, where John Paulson, a speculator, went to a hedge fund man, I think, went to Goldman Sachs and said, "Give me something to bet against." And so Goldman Sachs went out and solicited all these investors without telling them that this structured financial product that they had set up was set up specifically to give John Paulson some junk to bet against. So it was junk in there. Anyway, so there are enormous frauds being concealed by this curtain. So we don't need to feel bad. When the banks tell you, oh, it was just, they were just being sloppy when they, all this thing about the robo-signing that's been in the news lately, they say, well, it was just convenience, and so we faked all these affidavits. They weren't being sloppy. That was intentional. They could not have done that paperwork correctly in the beginning because they needed this curtain behind which they were trading all the time. I mean, they didn't know who was going to own this property until it was foreclosed on. There was no way they could transfer it straight out of the gate. So there's this huge fraud going on. So if the banks tell you, or the politicians or anybody, well, we're just going to take care of this little problem that's making an inconvenience for the banks and slowing our banks up from doing what bankers do, don't believe that. That's not true. They were doing something totally fraudulent, and they're being held to a totally different standard than we are. I'm a lawyer, and I clerked for 3 different judges, and the first thing we learned was your job is to throw this stuff, find something wrong with this paperwork and throw it out, because the judges do not have time for it. Find some technicality that one of the parties has done and get rid of the case. So these banks are in technical default in all this paperwork, and it can't be cured. And so I know what's going to happen is probably in this lame duck Congress, they're going to go in and say, they're going to have some bill that says, well, we're going to smooth over all this stuff and make it all legal. The thing that's been illegal for 200 years, we're going to make it legal. So just don't stand for that. You must know that there's big fraud going on here, and it's our big opportunity to stand up to the banks, and we should grab it.
Yeah. Definitely second that. And this is, I think, a lot of what keeps people in the mortgages and putting up with the situation right now is they feel some shared responsibility for what's actually happened. But clearly this whole bubble has been driven by the banking sector. And I find it quite bizarre that people who are, the lower socioeconomic echelons, or people who actually raise mothers, in Australia we call them mum and dad investors, that was the term that was used, and they're now being blamed for taking on too much mortgage, that it's all their fault. They were supposed to be raising kids, not gambling on financial assets. The banks were the ones who persuaded you all that it was feasible to take on this level of debt. They got it wrong, and in fact, they made money out of getting it wrong. So if you find a position, a way to get out, as Ellen's suggesting, that means you don't have to honour those mortgages, that's actually moral behaviour by you, in a sense, because you're saying, this was done evilly in the first place, you shouldn't honour it. And it takes something I know from my brief legal training. There's a law in equity. The law of equity says that somebody can't defend their rights in equity if they come to equity with dirty hands. And I think that the banks definitely came to this entire thing with dirty hands. They do not have the right to enforce those rules of good behaviour when they themselves didn't obey them in the first instance.
Okay, so I have a question then. When all these mortgage documents were created, all the subprimes and whatnot, on the banks we have double entry bookkeeping, where the debt is an asset to the bank, the mortgage paper, right? And then the credit is created, bank credit, which is spent into the economy. So maybe, let's say, $1 billion of each during whatever time period. If all of this debt, this $1 billion in debt is unenforceable, is what I hear Ellen saying, then that debt basically is going to have to be written down by the banks, and then what happens to all these credits that are supposed to be backed by the debt?
Well, I'm not quite sure what you mean, but I will say that you were talking about inequity. The investors, if all these homes are owned free and clear, obviously the investors have lost a lot of money. But the fact that the mortgage can't be foreclosed on does not mean that the investors don't still have a good claim against the borrower for money. What they have is this promissory note that you signed. But it's not backed by real estate. That's the thing. And the problem is we don't know who the investors are. There are all these different sets of investors, and you hear these cases where somebody gets foreclosed on twice by two sets of investors because the way they were doing this whole Ponzi scheme was that they would sell it to various sets of investors, and the whole trick was to make sure that they didn't all foreclose at the same time, because once one would foreclose, then they would substitute a property in this whole scheme so they would all have some sort of property. So what has to happen is the investors have to come forth and prove, first of all, that they are the investors that put up the money for this particular property, and second of all, that they haven't been paid in some other way, because in equity, that's the whole thing. You're showing that you're out the money. So if you've been compensated, for instance, with derivatives, which many of them have, they've been compensated by insurance. Derivatives are sold as insurance, the credit default swaps. Then you could own your home free and clear. I mean, who's out is the people who bought the credit default swaps, but they probably can't. I mean, they might have a case. All these around the world, you've got a huge, many investors who have been taken advantage of here, and they could all have lawsuits. But what they're going to have trouble with is proving their actual damages. In other words, proving that one particular set of borrowers was where their money went to, or yeah.
Well, in terms of the money, if the debt is actually written off, then it's the equity holders in the bank who have to take the hit, because they've then got to make up for the drop in equity. There's no necessary reason why the depositors have to lose their money if you have a system of government guarantees as well, and fundamentally they shouldn't do it. If the one thing we learned from the Great Depression, it was that you don't let depositors lose their money.
But what happens when the equity holders in the bank, when all that equity drops to zero and there's no equity left?
Then you've got a nationalised bank. It's in receivership.
But isn't it probably true that many banks are already in that situation and they just haven't accounted for the write-down on the assets
Very
yet?
true.
Yeah, for sure. And what you're doing is exactly what I saw Americans criticise the Japanese for doing back in 1990. You're keeping the zombie banks alive. You're not writing off the debts and reorganising them and selling them later as solvent institutions. You're forcing them to stay alive, but you're cash feeding them to keep them alive when fundamentally they're insolvent. They should be put into receivership, nationally managed for a while, because that's the only organisation big enough to do it. The debt-generated money they created being replaced by fiat-backed money so that you don't lose the depositor base. and then ultimately they get sold back into the private sector once you've reformed the financial system to stop this sort of behaviour happening again. But you certainly have to get rid of them, whereas what's happening at the moment, they're trying to preserve them. The amount of money wasted to keep the American shadow banking system and major banks alive was ludicrous compared to what could have been done if that same money was used to reflate the economy, pay the debts down, and then trash the financial system, which had already trashed itself. That's what should have happened. So Americans had a great time lecturing the Japanese about what they'd do if it ever happened to them, but of course it couldn't happen to America because it was far too transparent and well managed. Well, 20 years later, you've got a bigger mess than the Japanese ever had.
At some point, price discovery is coming. We're going to see mark-to-market. And for instance, the structure of the CDS market might provide incentives to burn things down for profit. And then you can get price discovery from forced sales.
Tell me a story about how that would work, like with some fictional companies.
Well, I mean, CDS contracts are basically, they allow you to take out insurance on something you don't own. So this is like letting me take out fire insurance on your house, and then I might just have an accident with matches. And it gives people an actual incentive to force the very behavior that can give you price discovery and mark to market. And
Are you
at that
saying
point,
one bank
extend and
attacked
pretend is over.
one bank attacking another bank then?
You could see something like that. But because there's no capital adequacy regulation in derivatives, you could actually find that having forced something to go under and having ended up with price discovery, you nevertheless can't claim on your winning bet because the person who ended up owning the other end of that bet was in no position to actually cover it. Because so many of these contracts got sold on to the point where even if the person who would have been your original counterparty would have been able to cover the bet, whoever ended up with that contract may not be able to. So I think the whole CDS market has a built-in meltdown mechanism. And essentially that's how extend and pretend is likely to end. And I don't think we can keep it going like the Japanese did. And the Japanese had an enormous amount of money to burn through to start with, and they had an export-oriented economy that was able to sell into a massive, booming global market. We're not in that position on either front, so I cannot imagine us being able to manage extend and pretend or to keep zombie banks alive for anything remotely like the way that the Japanese did. I mean, I really think it's going to be game over in the relatively near future. I can imagine a great deleveraging between 2 and 5 years from now. I think the thought of 20 years from now, like in Japan, I think is pretty much inconceivable to me.
Let's talk about risk for a second then. One of the things we've been thinking about at the conference is that deflation may be occurring right now, and that means there's less money to go around, and that we might have perhaps another recession or a continued recession or a double dip or triple dip or a depression, whatever. What would you say is the risk, the probability in your estimation that within 5 years of now that we're in a depression type situation like back during the 1930s? Between now and 5 years, what do you think is the percentage chance that we'll be in that boat, each of you?
I think we'll be in that position sooner than 5 years from now.
Well, so you think it's a 50% chance that between now and 5 years we'll be in that boat? 100% chance?
Very, very high is as much as I could say. It's not the sort of thing one can really quantify, but I would be absolutely stunned if we were not in a full-blown depression in 5 years' time.
So we'll give you 95%.
I'll give you 90% that we won't be in that situation. I mean, we certainly would be if we went the way things are going, but I think we can turn it around. So I'm betting on
So you're saying
people.
10%
I'm betting on
chance.
the people, yeah.
Okay. Steve?
I'm in the 90% bracket, and I think actually it's arguably you're already there because we tend to be we're leaving the U3 figure as indicating level of unemployment in this country. Now, there are 6 different.
What's U3 then?
Okay, it's the figure that's published as the unemployment rate in America is actually called the U3 rate, U-3, by the Bureau of Labor Statistics, and they publish U1 to U6. Each of them excluding various groups. I think U1, for example, excludes new school leavers or things like that. U2 is another set of exclusions. U3 is the one they say that's our official rate. But they go out to U6, and U6 includes everybody up to and including discouraged workers who have been who stopped giving up stopped looking for a job up to a year ago. Now, you can go beyond that and then take a look at people who actually gave up looking for a job more than a year ago and have stopped searching at all. That, when you include those people inside, you get an unemployment rate, according to Shadow Stats, of 22.4% right now. Now, looking at the figures, John Williams, who runs Shadow Stats, says from his estimation, the U6 measure is probably closest to what we'd record as unemployment now, comparable to what we'd record back in the Great Depression. And he said if he actually used his broader measure, then he would have had an unemployment rate during the Great Depression of 38%. It actually peaked at 25. So if you're saying that the peak unemployment rate in 1929 to 32 was 25%, and you're currently at 17.1% on a comparable scale, then you're already in a depression when 1 in 6 people can't get a job. Okay, that's already a depression level. And in terms of the timing of that, it's almost precisely on the same length of time from when the crash began in the 1920s. Because again, looking at my argument from the point of view of when the peak debt contribution to boosting demand occurred and going forward from there is 2.5 years, that puts you at the end of 31. And hang on, the beginning of 31. About the beginning of 31, your unemployment rate was about 18%, 17 to 18%. So on that basis, you're already there. You're already tracking a depression. And I have great faith in the capacity of the economic managers of this country to stuff it up, not to know what to do, and to continue down the current course. But the difference is the sheer scale of spending will be greater than during the Great Depression by the government, and that may attenuate it. So I expect more of a Japanese situation where you drag it out far longer than occurred during the Great Depression. Remember, the Japanese have been in a depression-type slump for 2 decades now.
I would see the difference between, I wouldn't say we're in the Great Depression. I mean, my parents went through the Great Depression, and I've heard these stories from Detroit. That's where my dad grew up. And my grandfather was out of work, and my grandmother had 7 kids. And so the difference is that now we have all those things that were put into place in the 30s. In other words, we have Social Security, we have unemployment insurance, and food stamps, and various forms of welfare. So you don't hear those same stories. I mean, to me, depression is where we're actually literally starving, and we don't have, or many people are literally starving and they don't have resources. And so I wouldn't think we are there yet. Even I would agree our unemployment is the same.
I would say that when we went through the Depression in the 30s, we were several years into it before we heard the word depression. And there were so many optimistic noises people made all the way down. There's some interesting charts available on the internet showing what was happening with the markets and what people were saying at what point. And they were optimistic well into the end of 1931. So I think we have begun this deleveraging, this unwinding. We are in deflation, and we are well on the way to depression, if not already there. But we have not yet recognized it. And I mean, we ran an article on our site comparing the market chart in the 30s with the similar sort of chart with the things people are saying now, and basically saying, you are here.
And then there's actually a wonderful website called News from 1930, which started, I think, about 2 years ago? Yeah. And I've forgotten the author's name. I actually met him. He came along to a talk I gave in New York, a great guy. He just decided that it felt like 2009, I think, felt like 1930 to him. So on the 1st of January 2009, he published articles from the Wall Street Journal on the 1st of January 1930, and then he's tracking it forward. And you see all these wonderful comments about how the market's been up for 4 or 5 days, and if you don't join the rally now, you'll get wiped out, etc., etc. You know, and it's just around the corner, and the Fed's doing all this stuff, and it's a brave man who bets against the Fed, etc., etc. So it's amazing the extent to which the pattern's being repeated, though I do agree with Ellen that the fact you have Social Security there and food stamps and all the systems that were put in place, they've been denuded and eroded in the previous 50 or 60 years, but there's still more than you had when the Great Depression began. And that means that people fall down to a very, very low, bad level, but not as low as they would go if there wasn't welfare checks in the system and unemployment benefits. But even there, of course, you let your unemployment benefits run out after a period of time, which is blaming the workers for being unemployed, saying you couldn't find a job by now, it's your own fault. Not true. It's systemic failure, and you need to have an unemployment insurance system based on systemic failure as the problem, and not the fact that workers are too slack.
Well, I know a number of people who would say that as far as the unemployment running out, it should run out. I mean, why shouldn't they be able to get a job after 99 weeks? I mean, come on, 99 weeks. Why aren't they getting jobs?
It's because they didn't swim across to China.
Come on now, Steve. This is a serious question. Why aren't they getting jobs? They've got 99 weeks. They are not looking.
Yeah, that's
this
true.
is what
Yep,
I have.
I rest my. They should have dug to China then. It's not workers who create jobs. Workers find the positions that exist. But if you have that many people looking for positions and they can't fill them, then it's simply the vacancies aren't there. And it's the capitalist system is not producing it, and it's not the fault of the industrial capitalists so much, though a lot of them sent their factories off to China, so they certainly have complicity there. It's the finance sector stuffing up again. And as usual, the finance sector manages to get us to blame ourselves for what it does wrong. And it has a history of that going way, way back in time. I mentioned earlier in the talk one of my favourite quotes from Marx in Volume 3 of Capital is where he suddenly lashes out against bankers. And one thing, there's a lot of myths in Marx, and by the way, Marxists often hate me more than neoclassicals do, which is quite an achievement. He did a brilliant historical study of the financial cycles of England, and at one point just threw the pen down, and you can see it happening in the British Library, and said, talk about centralisation. The moneylenders and usurers that surround them constitute enormous centralisation, and it gives this bunch of parasites the power to interfere with actual production. And he said they know nothing about it and should have nothing to do with it. Well, he could have written that 2 years ago. He wrote it in 1870. Now, that's the potential for the financial sector to cause crises like this is a unique aspect of the monetary system. And when's the last time you heard of a worker crisis? You know, okay? Capitalism doesn't have them. It has financial crises. So it's the financial sector which is at fault and needs to be reformed, and yet they have a tremendous capacity to make us feel guilty for the stuff-ups they cause.
Okay, then about 2 years ago when things really seemed to be looking bad, I think it was September or something, and the Dow market really dropped. One of the TV shows in the U.S. called Saturday Night Live started airing on Thursday night, and one of the characters was the fix it, just fix it. Yeah. And he was sitting there and doing this. So I think many people are probably curious, how do we fix the problem? How do we fix this? Or is it fixed? If I listen to the TV, they say it's fixed. We're on our way up.
I'd say there's two questions there. If it was like if the three of us were in charge, we could probably have it fixed in a few weeks. But the question, well, we think so. But the question is, how do we get the power to implement the things that we know need to be done, but nobody else agrees with us? But if it were up to me, here's what I would do. Nationalize the Federal Reserve for starters, then allow Congress, instead of funding through debt, which never goes away, we just keep rolling over the debt, but it just looks bad, and then we have to pay interest on it, just issue the money. Allow, make sure that Congress has all these checks and balances so they don't go overboard, and keep it all within, make sure you're actually monetizing your future productivity and stuff so that it matches your productivity. But let Congress issue greenbacks, or the dollars themselves, instead of having to borrow from the Fed or borrow from the market, which gets them from banks, which ultimately create them. And have a publicly owned banking system so that every state would have a publicly owned bank, so you'd have a network of publicly owned banks. I mean, I think ideally banking should be a public function. I mean, it should just be like the post office or libraries or education. It's all we're dealing, or the court system. In fact, it probably should be part of the court system, because all loans today or all money today originates as a debt, which is merely a promise to pay, which is a legal agreement, and you want judges or you want civil servants overlooking your legal agreements. You don't want to farm this out privately. In fact, there's a big issue right now where all these companies are making people go into arbitration, where the company gets to choose the private arbitrator who always decides in favor of the company. all those arbitration agreements you see. So anyway, so have a public, I think ideally, the whole banking system would be public.
I'll disagree with that.
Okay.
And that is because I think one of the important functions of banking is to provide money to entrepreneurs who don't have the money themselves for innovations that actually, some of which will turn out to be worthwhile. And that really is an area where you want private decisions being made, because I've had two reasons. The banking makes a legitimate profit out of funding activities like that, if they do actually fund them instead of funding gambling on asset prices, which is what they've fallen into. So that's a legitimate role for private financial enterprise to do. And I'd also rather have the type of individuals who work in private banks and taking risks like that than public sector employees, where there tends to be a don't make a mistake mentality, and the best way to not make a mistake is not to innovate. So I think I see a need for a combination of public banks and private. Certainly public banks are better for funding households deciding to buy their own houses and so on. But if you want to have something like the SkyTrans system developed for transportation, magnetic levitation and computer design taking the place of cars, for that sort of thing, I think you need to have private financiers taking the risks.
Well, I would agree. You certainly need private funding, but that wouldn't. I would define banking as creating money out of nothing. I mean, what we're talking about, where they create credit, and it seems to me that that part should be a public function, and that you can always have private investors who are willing to lend to any project that they think is worth developing.
The trouble is that then remains the government's got the responsibility of deciding how much money to issue. And like if you could actually redefine the financial system, this is a bit like the AMI proposals, where the government would create the money by spending it into the economy, and then banks could exist which would have accounts at the central bank from which they would lend.
Yeah, I don't agree with that.
I don't like it either. I'm saying
that I think most money should be created by people themselves when they take out loans. In other words, when you need a loan, and so the natural way to create money or credit is you go to the great credit system, which is our community credit system, and you take an advance against your own future productivity or whatever you're going to pay it out of.
That then again would work for people buying a house somewhere, creating money. What about when Intel wants to build a new chip facility? It's something which you can't ask them to go and do that at the public sector bank. You do need large-scale private financial institutions creating money as well, but having that role limited to supporting what entrepreneurial ventures are out there and making intelligent decisions about it, rather than, as they do now, trying to work out which share price is going to go through the roof and speculating, gambling on that. So
I think as a practical matter, it wouldn't happen anyway, that it would all become public. So ideally, you would have the public and the private options out there, and let's just see which one works. I mean, that's one reason I think we don't want something like a single currency globally, et cetera. We want little experiments going on all over the place, and then you can tell by trial and error which one works, because we can all have opinions about things, but it's people with the wrong opinions that get in power that mess things up. So.
To answer your question about fixing things, I actually don't regard this situation as fixable.
Oh, Nicole, come on. Why not?
It's mitigatable, but not fixable. I don't think there's anything that prevents us from going through a deflationary depression, anything at all. I don't think anybody can prevent that, no matter what they do. I think once you've had a gargantuan creation of excess claims to underlying real wealth through the mechanism of Ponzi finance, ultimately you're going to see an enormous deleveraging that will run to its natural conclusion when the small amount of remaining debt is acceptably collateralized to the remaining creditors, probably the few remaining creditors at that point, and then you can start to rebuild trust. But in the meantime, you can mitigate the impact with all sorts of things that we've been discussing today, like local currencies and time banks and ways to keep economic activity continuing in the absence of functioning national systems. But I don't see politicians or central bankers having the ability to do anything that will be especially useful. I think most of the initiatives that come from the top down, if anything, are going to make things worse rather than actually improve matters, because the people who run the system, who are in a position to make top-down decisions, are the very people who are the greatest vested interest in the status quo, and they also behave as the ultimate crowd. In other words, they're extremely reactive. They're not proactive. Everything they do will be too little, too late. They'll follow the market down. Things that they try to resolve, I think, will be overtaken by events. And this foreclosure gate, I mean, you can imagine a scenario where there would be 20 years of litigation over this horrendous can of worms that has now been opened. But if the entire thing simply is overtaken by events, and you get basically a grab for underlying real wealth. So, I mean, essentially we're all playing a giant game of musical chairs, and there's one chair for every 100 people. And so imagine what happens when the music stops. This doesn't unfold nicely in accordance with rules on the whole.
There's two concepts here, and I agree with both of them. The first is you can't get out of this without pain. And I'll give you two arguments for that. One is that when I argued about the demand in the economy being the sum of income, GDP, plus the change in debt, then if you're going to reduce that debt over time, you're going to have aggregate demand being less than aggregate supply and a depressing impact on the economy. You can accelerate the process of getting that right and attenuate it by saying, let's abolish large slabs of that debt, turn it into fiat money instead, enable people to spend that, and then have a boost in their spending power because they wouldn't be wasting their money financing their mortgage. They'd have free up a large part of this expenditure and be able to spend into the real economy. So that's a positive, better than going through the painful or drawn-out process. But then what you'd be exposing is something like about 25% of your population are involved in jobs that are useless. Merchant banks at the top of the list, financial advisors near the bottom. Okay, I mean that in every possible sense. A fair load of the real estate agents who don't do anything worthwhile, and we don't need that many of them, etc., valuers and so on. Huge slab of the population involved in useless work. Now, if you'd like to put them to work in factories, again, they've got to do this little trick I call swim to China, because that's where the factories are. But back in the Great Depression, when you had the crash and you came through the other side, at least you could put all those stockbrokers to use on Ford production lines. Okay? Now the Ford production lines, well, not the Ford so much, but the other production lines are in China or Mexico and so on. Your industrial capitalists have taken advantage of cheap wages and shoved the jobs offshore to increase their profit margins. But they tried to maintain a mass market while getting rid of the workers, effectively. Well, the only way you can do that, the workers going into debt and paying for it, that's no longer possible anymore. You're going to see a currency collapse as well because you've been buying goods cheaply from China, taking advantage of those low wages. China's been very sensibly industrialising at the expense of American industry through the whole process. So when you get to the end of it, you're going to expose that you've been following the wrong industrial path for 30 or 40 years. Now, you can't expose that wrong path and get back to equilibrium instantly. So I think that's the pain part you can't avoid. And then, again, agreeing with Nicole, I expect them to do all sorts of foolish things in their attempts to manage the economy, talking about the people running the Reserve Bank and the Treasury, and they will often do too little too late. So they'll believe the myth of the money multiplier, for example, as Obama was persuaded to believe 2 years ago now, and put $700 billion into the banks and get almost no impact out of it. And they'll do it again and again and again. And that's what the QE2 is about, giving the money to the banks rather than buying the bonds off the public or buying the bonds off the government. They're buying them off the banks. They continue expecting the banks to create additional debt money and not doing the world who wants more debt in America right now. So they'll extend the problem for many years until they finally do the right thing. But it might take them 5 or 6 years to get there. And in the meantime, what they'll face is a de-industrialised America. They have to re-industrialise.
Is it actually possible to continue that much longer, though, in the Japanese style, or are we going to end up coming to another point where there's panic in the markets and everything starts coming down again like it did in 2008 September, and actually all the way until March, I think it was on its way down, wasn't it?
I think that's exactly what's going to happen. Things like QE1 appeared to have some limited effect because it had the psychological support of a rally. Rallies involve a resurgence of confidence and a renewed suspension of disbelief. Those are the circumstances you need to make things look successful. All the attempts to create, say, super SIVs and things that were, that Paulson was working on the year before, none of it worked because we were in a declining market at the time. The collective psychology did not support those efforts appearing to work. I think the rally that we've had is very close to topping at this point. There are very extreme sentiment indicators in a number of markets that all turn with the ebb and flow of liquidity generally, so you have an all the same market scenario. I think we're very close to a top in stocks, agricultural commodities, gold, oil, and very close to a bottom in the dollar, and hence the end of the suspension of disbelief, the end of the collective optimism that makes things appear to work. Rallies are kind to central authorities. Renewed declines are absolutely not. So once we move into the psychology of a declining market again, a contractionary psychology, I think everything they try and do is going to fall flat on its face, and it doesn't really matter what they try to do. I mean, Hank Paulson would say, well, if you have a bazooka in your pocket, you're not going to have to pull it. Well, you are, because the market will call your bluff at every single stage, all the way down. And every time you try it and every time you fail, the next time you just look that much more desperate. So a lot of deflation has a very strong psychological component. And it's very difficult to fight the collective psychology. When you have the power of the collective moving in one direction, like lemmings over a cliff or whatever it might be, there is a tremendous amount of power there. And it's the difference between, say, light that's pointing in all sorts of different directions or light that's all in one direction, which is a laser beam. And you can do a great deal, or a lot of movement can happen in a short space of time when you have the power of the collective all focused in one direction. So you have the sum of millions and millions of self-interested short-term decisions, whether that decision is to run off the edge of a cliff altogether or whatever it might be. Moves like that move markets enormously, and that's where you get market cascades and events like that from. These are tremendously psychological. And markets don't crash right out of the gate, so it's not that I'm suggesting that the rally ends and then we immediately see a market crash, because these things are swings of positive feedback in both directions. They start slowly and pick up momentum in the new direction, and then you would get arguably a point of recognition, and then you start to get cascades in the direction of the new trend. A point of recognition is where people recognize that the larger trend has now turned down. And so I think we are going to be looking at market cascades. At this point, to me, it looks like we probably wouldn't see such a thing until, say, the first quarter of next year, quite likely, because it doesn't crash right out of the gate. But I think that sort of move is coming. And if you look at the sentiment indicators, you have to use sentiment indicators as really strong contrarian signals. So if you're seeing 95% dollar bears and 95% gold bulls and things like that, who is there left to act on those trends, to take those trends any further in the direction they're already going? The insiders are taking the other side of the bet all the time. That's what insiders do. They bet against where the herd is going, and they win more often than not. And I think we are on the cusp of a reversal very much like that within, arguably the next 3 months. It's hard to say. It's hard to call the top of rallies. Rally patterns are really quite complex, but I think we are really quite close to that kind of reversal, and then we're going to see every effort to institute top-down solutions face enormous hurdles that they had not been facing during the period of the rally.
I love your image, the metaphor of the scattered forces that are focused into a beam, and then you have a laser beam, which is terribly powerful. That's what I think we have to do. We can win this war, but we have to figure out how we're going to focus our forces so that many people understand what we understand.
Steve, what do you think of, what is your reflection upon Nicole's thoughts on the future for the market?
Well, I think it's good to take a look at the Japanese situation. The Japan's Nikkei index peaked at just under 40,000 points on the very last day of 1989 and bottomed at about 7,500 points. And is now it bounces between 7,500 and 12,500 points 20 years later.
So are you saying it dropped 75%?
Yeah, close to 80%.
I don't think it's finished, by the way.
Huh?
I don't think
No,
it's finished.
no.
Because
They haven't anything
every
to do.
mania
Yeah.
finishes below where it began. We're not below where it began.
Yeah,
in
so
the
I think
UK
we've got a
yet.
long, long way to go with the stock market in the same sense. And the rally that's been occurring recently, there was a rally in 1930. This has gone on a lot longer than the 1930 rally. But then again, also, so was the scale of the bubble beforehand was much bigger than the 1920 bubble. And the government intervention in the market has certainly helped prop it up. It's also been quite mysterious. I don't follow these things as closely as some people, but I've seen claims that for about the last 20 weeks, there's been more money coming out of mutual funds and hedge funds and going into it. And yet the prices have been rising on falling volume, which is a very strange phenomena on the markets. And that normally is what leads to a crash, not a huge bubble as we've had in the prices recently. So there's lots, I mean, I don't normally go for conspiracy theories, as I've made fairly obvious here today, but there's something strange about that, particularly when you add onto it also seems to be a huge amount of insider selling going on.
3,000 to 1.
3,000 times as many shares being sold
by
as bought by
insiders as well.
insiders. So all that sort of signs up as they're trying to get the bellboy to be the one who goes for the fall rather than Rockefeller. And that implies at some point there'll be a very sharp correction. My perspective has always been the market's been pricing in a rally that isn't there. Having seen the credit impulse effect, as I showed you in my slides earlier, that possibly explains where the apparent rally has come from, because if you have a slowdown in the rate of deleveraging, that gives you a boost temporarily, which is real in a fundamental way. But then to be sustained, you have to have a slowdown in the rate of deceleration, turning back into acceleration of debt again. And that implies rising debt levels for an economy carrying more debt than it's ever held in history. So I don't think acceleration will occur. You'll go back to deceleration once more, and then you'll get a real financial drive downwards coming on top of the pessimism effect that Nicole's talking about.
I want to understand, Steve, your point on the acceleration of the rate of change.
Yeah.
Could you give us some very simple numbers, like
Okay.
we were at 5%
I'll give
less?
you a numerical example, which
Okay.
actually works in terms of the change in debt, but you can see the rate of change coming out of it as well. And this is what I developed this before I saw the credit impulse research done, but it was my way of getting a handle on this factor. So imagine an economy, and by the way, the numbers are going to be very close to those for the Australian economy. They have two reasons. One, I know them, and two, they're nice, simple, round numbers, which suits some things that happen down south of the equator. Okay. Imagine an economy with $1 trillion GDP, growing at 10% per annum, where half that growth is inflation and half is real growth. So it's a booming economy with a moderate level of inflation. So it's going to start the year at $1 trillion and end at $1.1 trillion. And then the same economy has a debt level of 1.25 trillion, so its debt ratio is 125%, and debt's growing at 20%. So in that year, the GDP will be $1 trillion, and the change in debt will be 250 billion. So your total spending in the economy, $1.25 trillion. Okay? Then you go to the next year. The GDP is now 1.1 trillion for that year. What happens if debt stabilises? Debt doesn't change. So debt's reached 1.5 trillion, and that's where it stays. Then in that economy, which has grown 10% over the year, total spending will be 1.25 trillion in the first year and 1.1 trillion in the second. $150 billion lower. That's the impact of slowing down the rate of growth of debt. Simply a slowdown. Now, just to give you a slightly more complicated example.
So what you're saying is that people are borrowing more money than they're paying off in those years, and they're spending that money that they're borrowing.
And then they stop borrowing.
They stop borrowing.
And that causes a huge slump. That'd be a 15% fall in demand, effectively. Now, what about the other? Let's say instead, rather than debts stopping growing entirely, the rate of growth debt slows down from the 20% rate, which is twice as fast as the nominal economy is growing, down to the same rate as the nominal economy, 10%. Well, that would give you, you'd start with you have $1.1 trillion GDP, your debt's 1.5 trillion. If that grows by 10%, that becomes 1.65 trillion. That gives you a total spending in the economy of 1.1 trillion from the GDP and 150 billion from increased debt. That's $1.25 trillion. That's exactly the same amount of money being spent in nominal terms in the second year as in the first, but you've had 5% inflation. So the real economy has fallen by 4 to 5%. So simply the rate of growth of debt slowing down will cause a recession. Now that's where the acceleration factor comes in. So if you want to have an economy growing at a constant rate over time, where you've got a debt finance system, and if that debt's growing at 20% per annum, it's got to continue growing at 20% per annum to give you constant economic output compared to your population as that population also grows. So you become dependent upon the rate of growth of debt being greater than income. And that's the situation we got into and the situation you've been in for decades. So simply slowing down the rate of growth of debt is what causes the crisis. And if you take a look at the timing of when the crisis began, it was before you started to de-lever. That's a point I made in my call of the recession. First of all, I said it'll happen before you reach peak debt because simply a slowdown in the rate of growth of debt will be enough to cause a downturn in aggregate spending, which is what happened. So it's the acceleration effect of debt that really hits you with your rate of change of aggregate demand and therefore whether your employment's going up or down. It's a complicated issue. It took me a while to get my own head around it. So, you know, if you're feeling a bit like you had a bit too much wine at dinner when we actually didn't have any wine at all, don't feel guilty. It does take a while to comprehend these things.
So my visualization of this is I'm driving in my car at a constant speed. I'm going the speed limit, and that doesn't work for an economy because we have growing population. There's more people coming into the labor market. So what I have to be doing is I have to be slowly accelerating and watching the speedometer go up. Right?
It's actually if you imagine if you've got a growing economy and growing population and growing debt, part of the whole system, then going at a certain rate of growth of debt will feel like driving along the road at a constant speed. Okay, so you don't actually feel that you're moving. Your frame of reference is the car. So that this constant rate of growth of debt higher than GDP feels like you're standing still. Okay? If you want to have a boom, what you've got to do is put your foot down and have the rate of growth of debt accelerate, and then you're being pushed, your frame of reference is moving, and you feel the acceleration force pushing you back. That's when the debt starts to grow at a faster rate again than it was beforehand. But if you have the deceleration effect where you start to hit the brakes and you slow down, your body starts straining against the seatbelt instead, that's when you have a slowdown in the rate of growth of debt. So simply a slowdown can make you feel like you're about to hit something. You're slamming on the brakes. So that's why I prefer to work in terms of aggregate demand being GDP plus the change in debt, because that's easier to comprehend. But when you then take a look at the second order effect, you then get this acceleration in debt being what causes changes in aggregate demand. And that's what leads to the economy looking like it's improving or getting worse at any point in time. And at the moment, because you've been decelerating, because you've been deleveraging more slowly just recently, that's actually felt like the economy is improving. But it's unsustainable in the same way that if you're driving a car and you floor it, ultimately you reach a maximum level of acceleration you can achieve and therefore your velocity levels out. Now a similar thing applies here. If you're going to have a continued boost coming from slowing down deleveraging, ultimately deleveraging has to become re-leveraging. But there's so much debt that nobody's going to do that. So you've got a built-in acceleration limit, if you like, in the economy. And I think once you get to a certain point and you seem to be approaching it again, you will find people starting to go back into deleveraging again, and that will give you a genuine financial fall that will cut demand and cut commodity sales and also cut into stock market sales.